Thank you so much to Mr. Malhotra, the Revenue Secretary, for being with us this morning to help you understand the nuances of the announcements that have been done on the budget day, along with both the Chairman CBDT as well as Chairman CBIC. Thank you, sirs, once again for being with us. Thank you to all of you. May I request Mr. Singhania to felicitate first the Revenue Secretary with the green certificate, our traditional way of e-welcome, a green welcome of our guests. To the CBDT Chairman, Sir, Mr. Agarwal. Oh, okay. Sorry. And now to Mr. Agarwal. Thank you so much, sir. Of course, we all know a lot of progressive things have been added in this budget, and there have been a lot of vision sharing of the government on the paths that they want to take towards Atmanirbharta and Viksit Bharat. So we will definitely listen a lot more in nuances with the guests present here. May I request before that to Mr. Singhania for his welcome remarks. Yeah.
Good morning, everybody. Shri Sanjay Malhotra ji, Secretary Revenue, Ministry of Finance, Government of India. Shri Sanjay Kumar Agarwal, Chairperson CBIC. Shri Ravi Agarwal, Chairperson CBDT. Jyoti Vij, Director General FICCI. All my friends from industry, all the learned colleagues over here, members of the Government and Finance Ministry who come here this morning, and friends from the media, a very good morning to everybody. It gives me great pleasure to extend a warm welcome to Shri Sanjay Malhotra ji for sparing his valuable time this morning. I know, Sanjay ji, you must be running back to back much before the budget and even now, and you still have more extensive programs, so thank you very much for coming here, along with your colleagues this morning to FICCI, and share your perspective on the Union Budget 24-25. Let me also extend a very warm welcome to Shri Sanjay Kumar Agarwal ji and Shri Ravi Agarwal ji. And we greatly appreciate your being here and your actually wanting to spend time with us and have an interaction and hear feedback and views. Friends, the Union Budget 2024 was being looked at with a lot of anticipation. As the first major public policy announcement of the new government, it was expected that the budget would lay down a plan of action for the following 5 years, which I think it has done, and provide a ringside view of the government's approach towards the larger national vision of Viksit Bharat 2047. Further, while our economy is performing well, there were admittedly a few areas that merited attention. Employment and inflation being the foremost. As the Finance Minister rose in Parliament to present the budget, she clearly highlighted the theme of the budget and that the focus would be on employment, skilling, MSMEs, and the middle class. And with the 9 priority areas that followed, Finance Minister distinctly articulated the economic policy framework through which the government wishes to bring in the transformations that would hasten our movement towards the goal of Viksit Bharat. By addressing the near-term challenges, while keeping an eye on the long term, the government has ensured that this budget is growth-oriented, inclusive, and will create opportunities for all sections of society. We are happy that the budget takes into account several suggestions made by FICCI. In fact, before we came here, Sanjay ji was saying that he was asking that FICCI had made, and he remembered FICCI had made 10 very specific suggestions on tax matters. And he thinks he has covered all, and he's asked Jyoti to give a feedback as to whether anything has been missed out. So thank you for your taking note of our suggestions. While the macroeconomic aspects of the budget have been discussed in detail over the last 2 days, we have gathered here today to discuss the philosophy and intent behind some of the key changes that were introduced on the taxation side. And we could not have asked for a better team of experts to be with us this morning. At a broad level, the thrust of the tax proposals this year has been to simplify and rationalize the tax structure, improve taxpayer services, provide tax certainty, and reduce litigation. This last point, I believe, is extremely important because so much of matter is caught up in seemingly minor litigation and disputes. FICCI welcomes the announcement of the introduction of direct tax Vivad Se Vishwas Scheme 2024, which would expedite settlement of pending disputes. The proposal to reduce the time for reopening the assessment to 5 years from 10 years if the escaped income is rupees 50 lakhs or more is truly welcome and a step in providing tax certainty. Abolition of angel tax is a noteworthy measure to support our Indian startup ecosystem. Revising the slab rates under new tax regime and increase in standard deduction will enhance disposable income and boost consumer demand. Withdrawal of the 2% equalization levy is in alignment with global practices and has been a long-standing demand of FICCI and will instill investor confidence. We also note that the indirect tax proposals are aligned with focusing mainly on promoting domestic value addition, reducing trade bottleneck, curbing litigation, and improving the ease of doing business. All of these are truly welcome. The announcement to comprehensively revamp the customs duty rate over the next 6 months with focus on removal of duty inversions was much needed, and we emphasize that it should be done after deeper engagement and consultation with the industry. While introduction of Vivad Se Vishwas scheme in respect of direct tax matters is a step in the right direction, we believe a similar scheme to resolve pending disputes under customs is much needed and could go a long way in reducing litigation on customs matters. The proposal to decriminalize late payment of tax deducted at source, that is TDS, if the payment is made before the time prescribed for filing the TDS statement, would ease compliance. Similar relief for late payment of TCS may be considered. We truly applaud the proposal to codify the amnesty scheme under GST by waiving interest and penalty for the financial year 2017-18 to 2019-20 if the entire tax demand as per notice or order is paid. We believe that the scheme should also cover cases where part of payment of tax is made by the taxpayer in respect of issues not to be further litigated by the taxpayer. Expanding the scope of the amnesty scheme under GST would be a significant move in reducing litigation on GST matters. Sanjay ji, I remember many months ago, I had called on the Honorable FM and we talked about minor things that are coming in the way of GST. And I was also very pleased personally to see that the budget actually took heed of many of these matters on GST. On behalf of FICCI, ladies and gentlemen, I would like, on your behalf, to compliment the entire team led by the Honorable Finance Minister for having presented a budget that underscores a commitment to policy continuity, economic reform, and addressing pressing socio-economic issues such as employment generation, rural and farm distress, and overall economic growth, and continues to focus on simplifying the taxation policy and reducing litigation. With these words, I once again extend a very warm welcome to all the dignitaries on the dais and for their presence, and we look forward to hearing from them, and they want to hear your reactions, responses regarding the budget proposals. Thank you very much.
Thank you, sir. Indeed, I think we've had a wonderful budget, and you've kind of laid down some of the observations that we as FICCI made. So, sir, I just got the note which we had shared with you, and you're right. Many, I think 80% has been addressed. A lot of issues regarding the simplification, the dispute resolution. I think all of that, whether it was TDS or capital gains, some of those were the asks, and I'm sure there would be some more doubts around that, which we can address. So moving ahead, may I request the Chairman CBDT to kindly share his views, please?
Revenue Secretary Shri Sanjay Malhotra ji, Shri Harshpati Singhania ji, my colleague in CBIC, Chairman CBIC Sanjay Agarwal ji, delegates on the dais, delegates present here, ladies and gentlemen, a very good morning to all of you. First of all, let me thank FICCI for having given us an opportunity to interact and share our thoughts and also seek your feedback on the budget proposals that are before you. As has been mentioned, the suggestions given by FICCI, about 80% of the suggestions find their place in the union budget, which reflects the acceptability on part of the government insofar as suggestions that we receive from the stakeholders. So we, as would be evident, that the suggestions that come from the stakeholders, from the participants, are well taken and deliberated and accordingly incorporated suitably. So, and it is quite heartening that all these, the interactions and deliberations actually help in putting in place better systems, better tax administration. I would take this opportunity to just flag 10 big proposals in the budget relating to direct taxes. First is that the direct tax, on the direct tax front, the new tax regime with new slabs and rates actually is beneficial for all. For the salaried class who is opting for the new tax regime, the standard deductions have increased, the family pension thresholds have increased. And as a result of that, I may share that 2/3 of the taxpayers who are actually currently filing the returns have opted for the new tax regime. That reflects the acceptability of the new tax regime as such. People are finding value in the schema of things, and they are themselves opting for the new tax regime. In fact, on the corporate side also, last year's data reflects that 58% of the income was declared in the new tax regime. In the new tax regime this year, further for non-government employees, so far as the NPS is concerned, that the deduction and the reduction under ATCCD has also been increased from 10% to 14%, bringing it at par with the government salaried class. Then the budget also so-called that angel tax though Income Tax Act does not talk about angel tax as such, but then the provision which was being considered as it was being considered that somehow the investments were people were hesitant, I would say. So keeping in view those sentiments, these provisions have also been taken out from the statute, and perhaps this would help startups and other business initiatives to get more investments, and thereby the business would prosper. The next is rationalization of taxation of capital gains. There has been a lot of talk on this issue, but and then there are certain examples that are being also quoted. I may take this opportunity. We have also clarified it in different forums. But if we take actually the ground realities, and so far as the appreciation of assets are concerned, if we take that into account, the new tax regime with the long-term capital gains tax of 12.5% would be beneficial to most of the taxpayers who would be actually entering into transactions which would be subject to long-term capital gains. This is because the long-term capital gains tax has been reduced from significantly from 20% to 12.5%. That's a substantial reduction. And also the fact that the rollover in respect of the assets that have been sort of sold off, that rollover facility is still available to the taxpayers. So far as the capital gains is concerned, in case there is a capital gain, long-term capital gains, the rollover is there. And so far as the capital gains tax is concerned, because of the significant reduction from 20% to 12.5%, the tax liability in most of the cases, keeping in view the ground realities, most of the cases, the tax liability would be lesser. Then there is a rationalization of the provisions of charitable trusts. So there were two regimes that were there. So those have been converged. The convergence has been provided. Also, there were instances where, because of certain procedural delays, the exemptions or the recognition of those trusts were being denied. So that has also been taken care of in this budget, and relevant provisions have been put in place that in case there is a delay, then the delays can be condoned and the registrations can be provided. I think it would be a big source of big comfort to the trusts and also for the entities who are seeking registration for the purpose of Section 80G. The next is rationalization of TDS rates and provisions. So the TDS rates after analysis have been reduced from 5% to 2%, and also in the case of e-commerce operators from 1% to 0.1%, because we took this feedback from the industry, and what was found was that because of this TDS provision, there was a lot of liquidity which was blocked. Ultimately, a refund would be there, but then there was a lot of liquidity blocked for a substantial period of time, and therefore this thought that the TDS rate could be reduced from 1% to 0.1%. There has been the provisions also provide for decriminalization of TDS default. So that is also, that will provide comfort, substantial comfort to all the business entities and all the deductors community. And therefore, while keeping in mind the fact that the performance of the deductor has a direct bearing on the deductee also. So we have got to balance the interest of the deductor as well as the deductee, the taxpayer, because the TDS that is reported by the deductor, ultimately the deductee takes credit of it. So balancing the two, these provisions have been brought, wherein in case there is a default, to the extent that the deductee does not get impacted, the decriminalization has been done. Further, I may share that even the compounding guidelines are also that rationalization is under consideration, and we would come up with the approach on that issue in due course of time. Then there is provisions. The provisions have been introduced for streamlining of the processes, reopening of the cases, and assessments in the context of search cases. So in the last about 3-4 years, we found that there was multiplicity of proceedings, a lot of litigation on these issues, which was actually not good for the business, as well as it was not serving much purpose. And therefore, these provisions have also been rationalized. Now, in the case of search, all the cases of 6 years would be, prior to the search, would be taken in one go, instead of multiple proceedings, multiple notices, and therefore stretching it for a number of years. So that once a assessment is initiated in the case of a search, that would be completed within 12 months in one go for all the years taken together. We hope that because of these provisions, the litigation would be reduced, and a consistent approach and view would be taken on the materials, that is, on the basis of which assessments would be formed. Not only that, in case the taxpayers come forward and actually accept and disclose the income, then the provisions of penalty have also been rationalized. In fact, in case the taxpayer comes up with a clean hand, then no penalty would be there. So that is also one way in which we've come forward and said that, okay, if there is an intrusive action that has been taken place, there is a case for acceptance of that, whatever is the undisclosed income, and then finish it off, do your business. The next is litigation and appeals. So we are conscious of the fact that substantial cases are stuck in appeals and litigation, and therefore a scheme which is similar to the earlier VSVS scheme has also been launched. Last time when this scheme was launched in 2020, it was quite successful. More than about 1 lakh taxpayers had actually participated in the scheme, and the government also got a revenue of about 75,000 crores. So it was a win-win for both. And we expect that the taxpayers would take advantage of this scheme also, this opportunity also. And on one hand, the litigation would end, and on the other, it would provide more comfort to the taxpayer. Certain provisions have been added in the Benami Property Transactions Act also, where a waiver of penalty and prosecution in the case of Benamidar has been introduced to provide comfort to the Benamidar that in case he wants to come out clean and state the true state of affairs, then the provisions for the prosecution or penalty would be waived in his case. And last but not the least, the announcement by Honorable Finance Minister that in the next 6 months we will try to, from our side it will be try to, but then the mandate is that in the 6 months we will have a relook of the Income Tax Act, see that it is simplified, and we make it easier for the taxpayer to actually go through it, comprehend it, and perhaps it will also help in better compliance. So this is a big project for us. In the next 6 months, we'll take it forward. We hope that we would be able to bring out a regulation, a set of a new version of Income Tax Act, which would be acceptable to all. With this, I would close, and subsequently we'll get questions. We'll answer that. Thank you.
Thank you, sir. Of course, ease of doing business, simplification, compliances.
Sorry. Go ahead.
So dispute resolution, ease of doing business, simplification, I think been the underlying themes. And thank you, sir, for giving a little more detail on the provisions. May I request the chairman, CBI, Mr. Agarwal. Okay.
Revenue Secretary Shri Sanjay Malhotra ji, Shri Harsh Singhania ji, Past President FICCI, my colleague in CBDT, Shri Ravi Agrawal ji, dignitaries and delegates on the dais, ladies and gentlemen. Good morning and warm greetings to all of you present here. It is my privilege to address this esteemed gathering today at FICCI's interactive session on the Union Budget 2024-25. I would like to extend my heartfelt thanks to FICCI for providing this platform to discuss and deliberate on the budget proposals that have been set forth by the Honorable Finance Minister. The Union Budget is not just a financial statement, it is a vision of the nation's economic future, a roadmap that guides us towards growth, development, and prosperity. It reflects our priorities, addresses our challenges, and sets the stage for achieving our collective aspirations. The goal of the government is to make India a developed nation by 2047. If we take a look at the budget from this perspective, the indirect taxes in particular, the indication is clear and that we need simplified taxation and rationalized rates to enhance supply chains and ensure that our industries remain competitive globally. To give you a comprehensive understanding, let me delve into the key highlights of the budget proposals on indirect taxes. Firstly, the budget proposals clearly focus on giving a significant boost to domestic manufacturing. Measures have been taken to counter the influx of cheap imports and correct duty inversions where necessary to protect the domestic industries. For example, the import duty has been reduced to zero on 25 critical minerals that are not mined in our country. This move will encourage the processing of these minerals, which are essential for manufacturing goods in sectors like green energy, defense, and space programs. On the other hand, products for which we have substantial domestic manufacturing capacity, rates have not been significantly varied. This ensures that our local capacity continues to thrive without undue external pressures. Furthermore, the goods that benefit from free trade agreements and meet a substantial part of our demand-supply imports. The duty rates have been adjusted to diversify supply chains and reduce dependency on single source. In support of our export-oriented industries, such as the marine producing exporting industries, the rates on inputs have been lowered to enhance their competitiveness in international markets. Therefore, the BCD on prawns and shrimp feed and fish feed has been reduced from 15% to 5%. Further, the BCD on certain inputs which go in manufacturing of the prawn feed have been exempted with IGCR conditions. In certain cases like flax banners and ammonium nitrate, the duty rates have been raised to ensure a level playing field for the domestic manufacturers. On the other hand, the duty inversions have been corrected to produce like MDI, which is not produced in the country and entirely procured by imports, and which is vital for the manufacturing of spandex yarn. There, the duty rate has been reduced from 7.5% to 5% and made equal to the duty on spandex yarn. Another important aspect is the success of the phase manufacturing program, particularly in mobile manufacturing. Here, the duty will now be reduced to 15% from 20%, as the sector has achieved substantial growth, with domestic manufacturing reaching rupees 4.1 lakh crores in last financial year and exports to the tune of rupees 1.2 lakh crores. This reduction reflects the sector's maturity and deepened value chain. Also, as a social measure, the BCD has been fully exempted on 3 cancer drugs. Gold has always been a commodity of interest for the investors, manufacturers in the gems and jewelry sector, common man, as well as organized crime syndicates. Regarding gold, the duty was raised to 15% in July 2022 to address the worsening current account deficit due to high international crude prices. This measure helped reduce the CAD significantly. However, it also led to increased gold smuggling and shifts in import patterns to exploit duty concessions under FTA or DTFP scheme. Therefore, growth in duty collection from gold was not commensurate to the rate increase. To counter these issues, reducing the duty on gold and other precious metals which move in tandem with rate of duty on gold will eliminate the margins for illegal trade and promote legal transactions. This move will benefit the gems and jewelry sector by making raw materials more affordable and giving a fillip to legitimate trade. The gems and jewelry sector give employment to 5 million people and contribute significantly to the GDP as well as to exports. Coming to GST, we are expecting an impressive growth of 11% in GST revenue collections as per the budgetary estimates for financial year 2024-25. In the first quarter, the gross GST revenue collection stood at rupees 5.57 lakh crores and showing a growth of 10.1%. The net GST revenue collection for the center grew by 9.1%, amounting to rupees 2.56 lakh crores. Given that revenue growth typically accelerates in the later quarters of the fiscal year, we are confident in achieving our revenue targets. Another striking feature which I have been highlighting at various fora, that the nominal GDP growth in the last fiscal year was 9.6%, whereas the gross GST revenue grew by 11.6% and indicating a tax buoyancy of 1.21. This means that GST revenue growth has outperformed GDP growth, reflecting the inherent efficiencies in the GST tax regime and improved compliance levels. For this, I express my sincere gratitude to the taxpayers on behalf of the tax administration. When we consider the collection of customs duties and excise duties, we anticipate a growth of 8.2% in the current fiscal year, with total collection of 16.1 lakh crores on indirect taxes. The first quarter of this fiscal saw a collection of rupees 3.8 lakh crores with a growth of 5.5%. The proposed GST amendments in the finance bill reflect the recommendations of the GST Council in their various meetings, aiming to simplify compliance and provide relief to the taxpayers particularly those in MSME sectors, who face challenges in early years of GST implementation. I will also point out that the trade-friendly measures announced in the budget will be implementing the GST Council recommendations. And some of these changes which are now being carried out in CGST Act, IGST Act or UTGST Acts are that Section 128A of the CGST Acts will be amended to allow conditional waiver of interest or penalty or both in respect of demands which are raised under Section 73, that is where there is no suppression or willful misstatement, and the taxpayer pay the full amount which has been demanded in that show cause notice by a certain specified date, and this is intended for fiscal year 2017-18, 18-19 and 19-20. Additionally, amendments to Section 107 and 112 of the CGST Act regarding pre-deposit. There, the pre-deposit rate has been kept at 10% for first appeal, with maximum pre-deposit of 40 crores, or in that 20 crores for CGST and 20 crores for SGST. And on second appeal, earlier the pre-deposit rate was 20%, which will now be 10%, with maximum pre-deposit of 40 crores. Earlier it was 100 crores. And these changes will help cash flow and alleviate working capital constraints for businesses. A new Section 11A is being introduced to grant powers for waiving recovery of duties not levied or short levied due to general practice and facilitating regularization, which was earlier done by as-is basis. Furthermore, a retrospective amendment to Section 16(4) will now allow input tax credit for certain invoices or debit notes up to November 30th, 2021. And this will be for the fiscal year 17-18, 18-19, 19-20 and 2021. This provides significant relief for taxpayers who missed in taking or claiming ITC. Another striking feature is that an optional facility of filing GSTR 1A is now being introduced, and this form will be available maybe in a couple of days, and this will allow taxpayers to amend GSTR 1 details before filing GSTR 3B. This was a long-standing demand of the trade that some facility of making corrections in GSTR 1 may be provided. Now, with this introduction of this optional facility of filing GSTR 1A, this facility is now being provided, and this aims to reduce discrepancies and litigation related to differences between GSTR 1 and GSTR 3B. To combat fake registrations, biometric-based Aadhaar authentication will now be extended across India in phases, depending upon the preparedness in various states. The TCS rate on ECO is now being reduced from 1% to 0.5%. This will ease the financial burden on suppliers using ECOs. As you are all aware that numerous clarifications have been issued recently on the basis of recommendations of GST Council, which are providing clarity on classification, valuation, applicable rates, chargeability, ITC, availability, and other matters. In conclusion, the Union Budget 2024-25 proposals on indirect taxes demonstrate the government's commitment to enhancing domestic manufacturing, strengthening supply chains, and ensuring our industries remain competitive on the global platform. I look forward to the insightful discussions that will follow and the valuable feedback from all of you. Thank you once again to FICCI for organizing this session, and thank you all for the patient hearing. Thank you.
Thank you, sir, for giving some of the underlying themes that you followed in the indirect tax proposals presented at the budget. I may now turn to, of course, the Revenue Secretary himself, Mr. Sanjay Malhotra, for a brief address.
Good morning, everyone. Mr. Singhania from FICCI, Mrs. Vij, my colleagues from both the boards, Mr. Ravi Agarwal and Mr. Sanjay Agarwal from CBIC, ladies and gentlemen. Thank you very, very much, first of all, to FICCI for giving me this opportunity. We did this last year as well. And it has been always our endeavor, as also mentioned by Jyoti ji, that we try to get your feedback, we try to get your inputs, we try to have a consultative process, both in the budget formulation and then also in the policy and the implementation framework for the budget throughout the year. So indeed, very, very thankful to FICCI for giving us this opportunity to be present here to provide our point of view and at the same time, get feedback from you all. My colleagues, both the chairman, have already in great detail thrown light on what the proposals are, what the intentions are. And so I'll make my intervention very, very brief and short. I would rather, like to listen to you all and take your feedback, your inputs as to how, we should now go about implementing some of these decisions that have been taken in this budget. But before, we come to the Q&A session, I would, of course, like to thank, as was also done by the chairperson, on the excellent support and cooperation that we have been getting from the members of the trade and industry, which is visible in the high growth in the revenues, both on the indirect taxes and the direct taxes. They are reflective not only of how well the economy is doing, but also reflective of the better compliances that are being done by the taxpayers, because the revenues actually are growing much, much more, as was pointed out by Chairperson CBIC, not only in the indirect taxes, but also on the direct taxes. So that is really something that I would like to commend the industry about. The other thing that I would like to mention over here is that our approach towards taxation has always been and will continue to be in the mode of a collaboration and not a confrontation. And you would have seen in the past few years and also in the budget that the purpose of our proposals, both on the policy side as well as on the implementation side, are to take taxes wherever they are actually due, but do it in a way and a manner that that gives respect to trust, that gives respect to the taxpayer, and to collect them in as smooth and as hassle-free a manner as possible. So whether it is matter of introducing technology, as you have seen in the faceless system that was introduced for the income tax side, or whether you see it on the GST through the GSTN, where virtually all services today on GST are electronic and paperless. And this again, found mention in the speech of the Honorable Minister, that we intend to do so even for income tax and for customs. So how do we make it smooth and easy and hassle-free? And how do we reduce disputes? How do we simplify the law? The whole theme of this budget, policy, this statement, insofar as the part B or the revenue side is concerned, I think, revolves around 2 or 3 things. One is the taxpayers. How do we simplify taxation for the taxpayers, both on the law side as well as on the implementation side, because they are very, very important collaborators, partners in this tax collection. Some of the taxes, in fact, GST is in fact entirely collected by the taxpayers. Similarly, the direct taxes also today, 51% of our collections actually come through TDS. And so even there, you are not only the taxpayers, but also the tax collectors. So how do we make it easy for you? That is the whole exercise of the budget, and similarly also, going forward. While at the same time also not only make it easy, but also how do we become partners in this theme of development of the economy through taking policy measures which help and support the economy. So whether it is in the direct taxes, you have seen, we removed the angel tax, which was causing some consternation. We have decriminalized, some provisions and depenalized some Black Money Act proposals which were mentioned earlier. We are making it easier for foreign companies to do businesses in India, whether it is relating to diamonds or whether it is relating to some other aspects like shipping, foreign shipping cruises, foreign shipping companies, doing businesses here in the form of domestic cruises, or whether it is in reduction in the duties on the indirect taxes side, for the number of duty exemptions, reductions given, or whether it is relating to the electronic sector, the marine sector, lot of reduction in duties, so that the leather and the textile sector, there are a number of exemptions, critical minerals. How do we make these materials available to our industry so that they are competitive not only in the domestic market but also on exports? So the second broad theme that this budget is about, how do we support the Indian economy and how do we spur employment? The third, of course, the common man, there are some things here for the common man. And over there, a very broad, a very strong message has gone in. Also in the indirect taxes, of course, there is some relief on the direct taxes that you would have seen by reduction in the personal income tax rates. But even in the indirect taxes, measures like reducing duties on mobile phones, because we generally see only an increase in duty, we only see protection. And while we did so when the industry did need it, we, through this reduction, are saying that this support is not permanent, this support is not in perpetuity, it is not forever, and the industry also has to become competitive after a certain time. They have to improve their productivity so that the benefits that were given by the government in form of support through higher custom duties, ultimately they do benefit the consumers too in form of lower costs and lower prices of those products. So these are the 3 broad themes in this budget. Once again, I would like to assure you that our effort has always been and will continue to be to provide a hassle-free, simple, collaborative approach towards implementation of taxes. And that is visible, number of suggestions that came in from you, 80%, Madam was saying, that we did 50%. I said, well, no, I think we have done more. So she went back and she has checked. So she says 80%. See, we may not be able to implement them in toto, but the effort always is to keep your suggestions in mind when we are making policy, and also at the same time we are implementing the policy. I would like to over here mention that the Honorable Prime Minister himself also, in one of his interactions with us said that policies, we make well, but it is the rules and it is the implementation where, sometimes we are not able to carry the spirit. This is what he said, the spirit of the policy we forget in the implementation. So I would like to assure all of you over here that the spirit that we have in policy formulation, with the same spirit, we would like to and try to implement these policies. Thank you very much and look forward to your feedback. Thank you.
Thank you so much, sir, and you've kindly agreed to also interact with the audience here. So we have with us Mr. Pranav Saheta. He's the chair of the FICCI Taxation Committee, and of course, senior partner EY. May I request Pranav to moderate the question and answers, please?
Sure. Thank you so much, sirs, for setting the context and really putting forth such a fantastic effort in terms of the budget this year. Truly commendable, the whole approach of trying to build that taxpayer trust or rebuild the taxpayer trust between tax collectors and taxpayers is welcome. The simplicity provisions like TDS, capital gains, etc. are certainly commendable as well. The effort to decriminalize the Income Tax Act in many ways, TDS, financial asset threshold for the BMA, all of those are again very welcome. Addressing some of the genuine concerns of taxpayers, like abolishing the angel tax, the salary TDS, which can now take into account some of the aspects like TCS, abolishing the equalization levy 2%, allowing taxpayers to withdraw from the BAR, and all of those shows a genuine desire to enhance ease of doing business and address the genuine concerns of taxpayers. So certainly very welcome. We would love to have our participants and members raise their questions, especially coming out of the budget. Yeah, Neetu.
Hello, good morning, sir. I'm Neetu Gupta from Aviva Life Insurance. Thanks for giving us this opportunity of interaction. Sir, we have seen that simplification is very high on government's agenda, and we have observed that in the tax proposals as well, both on direct as well as indirect tax side. And the announcement that within 6 months we would see new direct tax code is really, music to the ears. So, sir, my question is regarding that. By when can we expect the draft to be in public domain for discussion? And we all know that in 2019 also government had received the draft. So will it be broadly the same draft, or in last 5 years, the updated version is in place and we will see something new absolutely?
No, so the FM in her budget speech did mention that this comprehensive review, first of all, it is not a new direct tax code. So she only mentioned that it will be a comprehensive review. Let me, just correct that part. In what form and shape it will be, that is for us, to now see and examine. But she did mention in her speech that this will be done over a period of 6 months. So a timeline has been given, which is 6 months.
And whatever finally is likely to come through, will it be opened up for public debate, I assume? Whatever the
Certainly,
review.
we will, consult in what form and shape, how we consult, how the consultation process actually happens. That is something, we would decide. But as I said, as I mentioned to you, we would like collaborative effort, not only, for implementation, but even, for policy formulation, especially, where sensitivities are not involved relating to tax rates, etc. We would like to consult. How do we do that is something that we have really not given it a thought. But this process The first draft, of course, will be prepared by our internal team. And then how do we consult the public is something that we will think over and then take it forward.
Thank you so much. Sunilji, you had a follow-up question as well.
Yeah, sir, I'm here on the right-hand side of yours. So, yeah, my name is Sunil Sangai. I chair the Capital Market Committee. So I'll have a question on the capital market. Sorry, I came in a bit late. So if you have covered this topic, then there's no need to repeat. One area which is relevant directly to capital market is a significant change in the buyback provisions. I don't have a quarrel with the change, but I just needed a clarification that now under the new construct, the entire proceeds which recipient receives from the company will be taxed, and the set off of the cost will happen as a capital loss, right? So for that, one has to have a capital income. Practically, from the capital market practitioner, sir, the buyback as such, the scheme itself will not work then, because the set off, to get the set off, one has to have the capital income. Then only the capital loss will get set off.
Yeah, so our understanding of the subject really is that buyback is nothing but a dividend. In majority, vast majority, in almost all cases, it is actually a dividend. And so if you accept that it is a dividend, then it should get taxed in the hands of the shareholders as dividend is today getting taxed. Your question, and if it is a dividend, and if we accept, that it is actually nothing but, an income because the capital structure otherwise is not, actually changing, then why at all, capital, on the capital account, something should be provided. If at all it is to be provided, it will be at the time, that capital is actually sold.
Maybe
so we did give
not
it a
getting
thought,
my maths right.
The other thought, the other thought that came in, the other proposal or the alternative could have been, that we give a loss or we account for it while making the income, while calculating the income right away. That actually means that we are treating the capital the money, on the capital account as a money on the revenue account. So that's why, we did not do it like that.
I can just follow up clarification, because you have given a very nicely in the explanatory statement, even an illustration with the amount, etc. So let's say, again, going back to the same, if my cost is 1,000, I get 2,000 back. So 1,000 rupees is a gain. That is akin to dividend. That should be taxed. Absolutely agree.
No. So no, we don't look at it like that. The 1,000 rupees remains with you. The point is that if you accept that this 2,000 is an income, the 1,000 rupees actually remains with you because it's in the company. The ownership of the company is not changing. It is the same. So if the 1,000 rupees was worth 100th share in the company, the 100th share remains. It does not change. And so whatever is, so that remains with you. So why should, that be allowed unless and until you sell, your shareholding or, the capital is actually, the company is liquidated or something like that.
Okay, not that.
Okay, thank you so much, sir. Mr. Ajay Sardana from Reliance.
To you and the Honorable Minister for the excellent budget which you have presented. A few points I would like to highlight, which you were also telling that you have considered the inverted duty structures and resolved them. But few of our cases are still pending, which we have explained to you during our discussions in that. So kindly consider them at the suitable time or in between, because these are very important for the industry. And if we keep on living in this inverted duty regime, industry will not flourish. So kindly look into that. We have submitted our representations and I'm sure you are aware about them. Second thing is that some of the anomalies which were there, which we highlighted during our discussions, were still not corrected. One example I can give is on the PET, where the department itself was feeling that the duty should be 7.5%, and a lot of clarification was sought and given, but still it has not been corrected. So we were expecting this to happen. So kindly have a look into that, because during our discussions it was felt that it is already 7.5 while it is 5. Another thing is that these issues whatsoever are where the industry is suffering, and a lot of investigation against China is happening through anti-dumping duties. So a lot of those recommendations from DGTR are coming. So kindly take favorable note on them, because both the sides industry is getting crushed. One side, the recommendations on the anti-dumping duty are not getting accepted by finance. In last 1 year, we have seen most of them not getting accepted. And on the other hand, we are not getting the adequate duty protection through duty increase. So kindly consider that and have a holistic view in next 6 months, as Honorable FM said, on the inverted duty structure, both in GST as well as in other products. Especially in textile, GST inversion is creating a lot of problem, where already the bill was there and it was to be implemented, but put on hold for some or the other reasons. So kindly implement it so that industry can flourish. Thank you so much.
So let me just try to respond, in a generic fashion. I will not be able to comment on the specifics because I do not recall immediately. But one thing, is that many a times, the inversion is correction is not possible, because there is not only, one product that is getting manufactured out of it. There are multiple products, and so if we try to remove an anomaly in one, it creates an anomaly in somewhere else. However, our effort is always, to do that. The other thing is also that we look at duty inversion not only in terms of rates. We look at duty inversion in terms of what is the total incidence of tax, not in terms of percentages, but in terms of the amount of tax. So whether it will actually result in a tax which is amount which is higher on the inputs than on the output, leading to a refund in case of GST. In customs duty, there may not be any refund. So we want to avoid that, not only the rate part. The third thing you mentioned about textiles, we are aware that there is a duty inversion in textiles. Let us see, how we can try to address it. Anti-dumping duty, most of the cases last 6 months, I can say with confidence, last 6 months, most of the cases of anti-dumping duty where the DGTR has recommended, we have accepted the recommendations. Very few which we did not accept. Nevertheless, that does not mean that we will accept everything that they recommend. And we have to be conscious, not only, as I was mentioning even earlier, that protection in the form of a support we would like to give wherever it is due, but at the same time we have to balance the interests of the consumers also. So wherever we do not accept, those are industries, areas which can have a large scale, widespread downstream effect on the consumers and the other industries. You want to add anything?
Revenue Secretary has adequately covered the issues which have been raised by you, because wherever any proposal is received, there is a lot of stakeholder consultation thereafter takes place. And we have to ensure that downstream industry, if some change is made, that what will be its impact on the downstream industry. In case of, say, you mentioned about PAT. So in textile, because most of the inputs for textile industry are chemicals which are falling in chapter 28, whereas textiles are falling under certain other chapters. And there, if we start correcting that inversion, then if we go to the end, then the entire chemical which is subjected to generally rate of duty or 7.5% will have to be changed. So all these aspects have to be taken into consideration before any proposal can be accepted.
Thank you so much, sir. So before I go to the next question, one question from me, sir. You've done a really, I must compliment you on simplifying the capital gains regime. It's really a super effort. One thing, while everything else has been either 12 months or 24 months as the period of holding for becoming long-term, short-term, for transfer of a business as a going concern, slump sale, slump exchange, because it was in a different provision altogether, still it continues to be 36 months. I'm sure it's an inadvertent miss probably, but under section 50B of the Income Tax Act, there it's still 36 months for long term, and maybe that's something that may be good to also streamline while this is happening. I'm sure it's completely unintended, but I just thought I'll point out. Also, when it comes to the board for advance rulings, you have now very rightly said that those who have filed before the authority for advance ruling and want to withdraw can withdraw. But the way the provision is worded, it says that it is only when it has not already been admitted that the withdrawal will be permitted. Now, these cases are sometimes so old, 7, 8 year old, and they might have been admitted 6, 7 years back, but nothing has happened thereafter because AR was not very functional, to be honest. And then BR has come. The taxpayer has moved on already. So if he wishes to withdraw, he should be allowed to withdraw even where the matter had been admitted, the application had been admitted, but was lying in a limbo for such a long time.
So are you saying that we have said that it should not be admitted?
No, it says that if it is already admitted, you are not. I mean, it doesn't clarify that you can't withdraw it, but the way it has been worded, it is referring to 245R2 without getting into technicality. Yes. So what is happening is, if it has already been admitted, withdrawal seems to be.
The intention.
The intention is not to actually block that. The intention was that whatever is basically pending and which has not been adjudicated upon, opportunity can be given to withdraw it. Now that you have flagged this issue, we'll examine it, and accordingly then we'll take a call.
Sure, absolutely. I see that it was an inadvertent miss, which is obviously possible in such a huge task. My request, Arvind, to raise his question as well.
So my name is Arvind Singhal. I work with the NatWest Bank. So, sir, my question is more around the safe harbor rules. So, I was part of the NASSCOM delegation which met you at the North Blocks a couple of months back. And there were suggestions that were made from NASSCOM side and from the industry on rationalization. So, one is definitely the rationalization of the transfer pricing rates that have been provided and the increase in the threshold. So, sir, any guidance on how these rules are likely to shape up is what I just wanted to understand. And any sort of clarity, and when are we expecting the safe harbor rules? And my second part of the question is on Pillar 2. I was reading your statement, sir, on Pillar 2 implementation in India. So I was reading your statement in the today's Economic Times, and you said the government of India has reservations around it. So again, any sort of guidance when India is looking to implement the Pillar 2 rules in India around global minimum tax. Thank you, sir.
So I will only mention that whatever request you have made, because the time was very short, we have tried to accommodate in the FM speech by saying that we'll come up with such guidelines. The rest of the details and Pillar 2, I will request Chairman CBDT to throw light on.
See, so far as the issue of Pillar 1 and Pillar 2 is concerned, that is before the international fora and that is under deliberations. So in all fairness, till the time that deliberation is going on, it would not be perhaps appropriate to actually deal with this and to discuss this. We expect that the inclusive framework declarations would be there shortly. And once that is there, then we'll firm up the issue and come up.
Yeah, Uday, you want to raise?
Okay. At the outset, I'm commenting on the great budget that you have kind of issued. This couple of questions I had. The FM announced that there would be a comprehensive review of the customs duty rates in the next 6 months, primarily for ease of doing business and removing controversy and also inversion. Is there any suggestion that you have as to how do we, from the industry associations and industry, engage on that particular exercise that you have? So that was one question. Whatever you suggest, then we can possibly follow up from our end. The second question was on the GST front. Of course, this is a GST council, kind of not directly related to the budget. But this extension of time for bona fide assessors and aligning the limitation period for both, fraud cases and non-fraud cases. Now, the problem with that is that from an indirect tax perspective, the uncertainty increases for bona fide assessors. Traditionally, for indirect taxes, especially central levies, the limitation period was used to be 1 year actually, and then it kept on increasing over the last decade. Now, with the kind of digitization that you all have, the data analytics that is possible, there is perhaps some merit to kind of look at for bona fide cases, giving more certainty to the industry. Because for indirect taxes, it's actually any controversy is goes through the pocket. It's not any adjustment to the income and so on and so forth. So it becomes far, far more punitive to have a very long limitation period. So just one consideration maybe can be looked at. I understand the simplification part of it, but perhaps with all the digitization and the benefits that has come in from a tax collection perspective, maybe there's something that the taxpayers can also benefit by lower limitation period. So these were the two.
So see, as I was mentioning, we like to take a consultative process, but where rates etc. are concerned, it is sensitive. I'm not sure we will be able to go through a consultative process for harmonizing the rates etc. on a formal basis. With regard to this section 74A that you mentioned. See, any simplification that we do will have some gainers and some losers. This is what we were discussing with Mr. Singhania. When we came in, we were discussing capital gains, and there are some losers. There are some gainers. So I think broadly, I think in interest of simplicity, I think this is a better provision. Is my personal view. And so that's why we have got this. Most of the cases, what we observed, even which are non-fraud, get classified as fraud. So the period was actually more, which we have tried to reduce. As this society, and as we gain more experience, because GST is really a very, very new law, as it matures, your suggestion, which is, I agree with the thought process, of your suggestion, but the point is that are we mature enough to be able to distinguish between, what is fraud and non-fraud? Do we have that experience? Do we have that maturity to be able to distinguish between the two? Perhaps we need little more time to consider your suggestion.
Excellent. Thank you so much for your great answer. Mr. Sanjay Goenka, I think, has been waiting for raising his question.
Good morning, sir. I'm Sanjay Goenka from DLF. Thank you for this budget. It has everything in it. I think simplification, ease of doing business, rationalization, decriminalization, and especially the thrust of the government is to bring back the Vivad Se Vishwas scheme to bring down the litigation. I have one suggestion that we should also look at the Gangotri where the litigation starts. Like in case of real estate industry, the ICDS was draft paper was released on 11th May 2017 and it is not yet notified, and this industry is going into various litigation since then. I requested Raviji also yesterday that so
I do not understand the issue. What is this draft paper on ICDS?
Sir, real estate industry, while the NDS which came into play, it has compulsorily said that completion contract method, the accounting should be done. So books are on completion contract method. But income tax department, because they have not come out with ICDS, the department is assessing on the basis of percentage of completion method. So what happens is it leads to a lot of litigation, and this litigation is going on for last 7-8 years, and it has piled up in the courts, etc. I'm sure, like real estate industry, the other industries.
Please give us a paper.
Yes, we will
on this,
I'll
and
meet,
we will have a look.
sir, and personally.
Okay. This has come to me for the first time, so that's why we are here to understand. It's not really actually a budget matter.
My thrust was, sir, my thrust was that like our industry, there may be other
Please
industries
give us details. Also give us details of the extent of litigation. As I said, we don't want litigation. Litigation is not in our interest. Litigation is not in your interest.
Yes, sir.
Because you people want certainty. You want an end to know what your liabilities are.
Yes.
And it is not in our interest.
Absolutely.
Too. Because if I have to get the revenue, if I have to get the tax, then I may as well collect it by clarifying it.
Absolutely.
And if I do not have to take the tax, then why should I bother you?
Absolutely.
Let me take your goodwill at least, which I should.
Thank you.
So it is not in anyone's interest.
Yes.
We acknowledge that fact. Wherever possible, we have seen it on the GST side. Number of clarifications, the council has been giving over a period over, at least the last 1.5 years that I have been around and I have been seeing it. And our approach towards taxation in all streams will be, in these lines.
Thank you.
Thank you so much. That's so heartening. So just one point, while there's so much that you have done for decriminalization, which is a great direction of movement, for TDS, for example, you said, as you pointed out as well, that if the tax deducted is deposited even after the due date but before the time for filing the quarterly return, it will not be regarded as prosecutable. Exactly similar provision is there in TCS, if it can be, so if that can be. The other part was on BMA and the threshold for foreign assets disclosures. Currently, you have raised it to 20 lakhs, saying no prosecution and no penalty and so on. So that has been done, that no penalty. If foreign assets which are omitted to be disclosed is up to 20 lakh threshold, great move. But the prosecution provision has not been amended. So the anomaly now is penalty will not be possible, but prosecution may still be possible. Prosecution is only one step further away. So I would feel that similar then threshold should be provided for prosecution as well.
I suppose that there would not be any threshold today for prosecution.
That is right. That is right.
So that anomaly was there even earlier.
Yeah, earlier there was only a threshold of that 5 lakh
only for penal
bank account. Yeah.
Only for penal provisions.
But only for bank account.
I understand that.
Yeah, that's
I understand that.
Right.
The scope has been expanded, the limit has been increased.
Correct.
But it was only for the 5 lakh limit restricted to bank accounts was only for penalty.
Correct.
And even over there could have been a prosecution.
Correct.
So that anomaly was earlier there and it has only accentuated.
Agreed.
Right?
Agreed.
That's the point I'm making.
Absolutely. You are absolutely right.
Yes.
Yeah. Okay. Mr. Mangal Dev from Hitachi. Yeah.
Good afternoon, everyone. I think I just want to make a few comments. I'm not an expert on tax, but representing industry, especially Hitachi being a Japanese company, and there is a big lot of Japanese investment coming into India. One of the biggest concerns that the Japanese companies have raised, I think, is very well echoed by Prime Minister, as you, Sanjay, mentioned about it. The compliances. Compliances is a very big task and very risky task. So how, and this point, as well as India is becoming, moving from a developing country to a developed nation. So the institution of tax has to become very, very mature. I think you guys do a tremendous job every year, to compile all the numbers and bring about changes. We see even today also large number of changes. So this means that we have to unlearn the past and learn something new. So this puts a lot of effort on the compliance part. So how do we see this maturing in the future? How do we see facilitating more and more FDI coming into India and India becoming a developed nation from the point of view of taxation and its implementation?
This is a very good question or a comment. A good question. This is a constant struggle. It is a constant struggle because while we would like the compliances to reduce. Ideally, there should be no compliance, because if people are self-compliant, you can 100% trust them. There is no need for supervision. There is no need for returns. People pay their taxes on their own. That is, the best ideal. It reduces costs for the taxpayers, reduces costs for us. Having said that, so it's a very, very delicate, balancing task that we have done, that we try to do. And while we simplify the law, this will certainly, the direct tax law, this is something that certainly, we will be mindful of, that where is it or how is it that we can reduce the compliances? Can the number of returns that you are required to file, without necessarily changing the information that you are required to submit, can that be reduced, for example? So we will certainly, that is certainly something which is on our agenda. But let me also assure you at the same time that we will our effort always on both direct and indirect taxes is to make life easier for those who are honest, those who are compliant, while at the same time those who are not paying their taxes and trying to evade taxes go hard on them. So let me assure you, the honest taxpayers, we will always support them, and we will do whatever is needed to make it easy, life easy for them.
Thank you so much, sir. That is very heartening and so good to hear, because otherwise, if you let the dishonest go, it adds additional burden on the honest taxpayer. So I think both things are very relevant. So just one or 2 points on TDS. One very good step is salary taxpayers can now, against their TDS, get credit for the TCSs, etc. Maybe on foreign travel, this, that, whatever the TCS can be creditable, and adjusted while TDS is deducted on salaries. The way that particular provision under 192(2)(b) proviso has been worded, it seems to create a lot of confusion as to whether the TDS can really go below the TDS that would have been on salary independent of that TCS. The way it is worded, it is capped. You can't go below the TDS that would ordinarily have applied on the salary without considering the TCS. Now that proviso again seems a complete unintended thing and may unnecessarily cause difficulty. That is one. And the other might be slightly difficult. Let me try. There are small firms, partnership firms, etc., where now a new provision is proposed to be introduced, 194T, saying remuneration and interest to partners will be subject to TDS. This could be a genuine compliance-wise and procedure-wise. I feel it's going to be a challenge, because the remuneration is determined much after the end of the year based on a percentage of the profits under Section 40B of the Income Tax Act and so on. So typically the partnership firm is able to determine the partner's remuneration only 2, 3, 4 months after the end of the year when they finalize their accounts and so on. So to pay the TDS at the earliest point of time of credit or payment of that remuneration to the partner might procedurally become a big problem for all partnership firms and LLPs, I think, because of the way in which they typically operate and the way in which 40B operates, which is a percentage of the remuneration. So that was the other. And if the partner has a permanent account number, if he is filing his tax return, at least in those cases, if you say TDS is not required because you have all the details, you have the firm's return and you have the partner's return, and the two are easily reconciled by your data analytics, I think. In that case, I was thinking whether it can be done away with, at least for those partners having PAN and filing their returns.
You understand the purpose. This, according to us, was an anomaly as to why, certain incomes, especially salary, should not entail a TDS, while others should. So the purpose is primarily that. But if there are procedural, and I mean, one is actually required to finalize one accounts, by 31st March. So in vast majority, I would tend to think that this should not be an issue, but I'm not an expert on this.
Yeah, sure.
So
yeah, just one clarification I give before yes, sure. That typically what the firm does is to maintain the living of the partner, they give money every month, but the actual number gets frozen only when the accounts get finalized. So it becomes a little difficult to deduct salary. It's more like drawings.
See,
or
actually,
this.
Formally, one is required to finalize the accounts, on the date, right? But practically, I understand the due date for you maybe, sometime in July or something, and the cash book actually is to be maintained, on a daily basis. So by 31st March, actually, it should be frozen.
Yeah, for partnership firms,
but they don't do it. They will make a backdated entry, isn't it? That's what happens. I have also run companies. It doesn't happen not only in firms, even in companies. Backdated entries are made. The books are kept open way past 31st March. So you are raising a problem which the law actually, to my understanding, does not recognize, isn't it?
Sir, there are genuine provisions.
Fine.
Details that are yet to come in.
We'll see, what can be done.
Sure. Thank you.
You see, so far as the salary is concerned, partner salary is concerned, that will also be part of the partnership deed also. So therefore, that is predetermined. The only thing is that this thresholds, which were earlier, those have been increased. But then that, so far as salary is concerned, that is predetermined because that is flowing from the partnership deed. Right. So therefore, irrespective of whether the books of accounts have been finalized and they would be finalized on a later date, the salary is in any case determined during the course of the year itself, and therefore the TDS can be deducted on that. And now, so far as you see, if the partner is filing a ITR and is having a PAN and correlating that, the issue is that when we talk about simplification, now we are adding one more layer for the department to actually reconcile this and then issuing of notices or communication that you have defaulted. So we should avoid that, right? And when it comes to simplification, it is simplification from both the sides. Right? That is what I would say.
Thank you. Thank you so much, sir. Yeah.
Hi.
Last two questions?
Yeah, sure. Thank you, sir.
Hi, good afternoon. I'm Rahul Banerjee. I'm the managing director at Risana House. We are a policy think tank. First of all, congratulations on the very ambitious budget, especially focused on green technology and renewable energy. Mr. Malhotra, you during your inaugural introductory speech, you have focused on how the government has focused a lot on renewable energy this year. And it is so with 19,100 crore allocated, but there still remains some financial constraints. Number one, funding gaps, because even after about a 78% increase since the last allocation, there still remains huge funding gaps, which can only be filled up by private investment along with international funding. And the second is subsidy. Most renewable energy projects are subsidy based or subsidy dependent, and any discrepancy in the subsidy from the government or from any other agency creates a problem for the project itself, project viability as well as investor confidence. How does the budget or how does some provisions address these issues? Thank you.
My understanding for renewable energy is that most of these projects are not on subsidy, based on subsidy. They are self-financed by either, the industry which is putting it up as a captive power plant, or by the household. For households, there is some subsidy, very small subsidy. There is sufficient budget available for that, let me assure you. But if it is, by the distribution companies, then they pay for it. So the only subsidy element, primary subsidy element comes in for the rooftop scheme that was announced. I think some 1 crore of households are to be energized and provided up to 300 units of electricity. There is sufficient allocation has been made for that. Let me assure you. And if still there is a shortfall, we will provide for it.
So can I take a question this side? So good afternoon. This is Sanjay Agarwal. I just wanted to check about the angel tax you've abolished. So the industry, what status does this have? The angel investor, the venture capitalists, what status do they hold? And why is it abolished? It's not for a limited period. So what's the status for them, sir?
The status for them, could you elaborate? So there is no distinction as far as the industries are concerned. It is across, because that section, that provision which was there, that has been removed from the statute, and therefore it is across the board. Right. And it is not limited to, in fact, the startups. It is basically now open to all the business industry. And the idea is that the investment that was otherwise, because of the perception that was not coming, would actually flow. That is the basic purpose. So there is no restriction as such.
Okay, thank you so much, sirs. We really appreciate for such frank answers and such a great budget. Thank you so much, sir. And please carry this house with a big round of applause.